Hello, and thank you for joining us today. I'd like to welcome everyone, including members of the media, to today's webinar, Enforcement Risks Under the CARES Act Loan Programs, What Borrowers Need to Know. This presentation will last 90 minutes. This webinar is available for CLE credit in California, New Jersey, New York, Pennsylvania, Tennessee, Texas, and Washington, and is pending approval in Illinois and Ohio. For all other states, credit will be applied for as requested. Please be advised there will be 2 points during the program where we will pause for CLE codes. During this time, a code will appear in the slide deck you see on your screen. Please make sure to write down these codes if you are seeking CLE credit, as you will be asked for them at the conclusion of the presentation. A CLE program evaluation will be available immediately following the conclusion of the webinar at 12:30 Eastern, where we will ask for your bar number and the 2 CLE codes. If you have questions, you can submit them via the Q&A box on your screen. We will do our best to address them toward the end of the program. Now, I'd like to take a moment to introduce today's moderator, Patrick Campbell. Pat is a member of BakerHostetler's White Collar Investigations and Securities Enforcement and Litigation team. He focuses his practice on white-collar criminal and civil regulatory matters and internal investigations, specifically in the areas of securities, construction, corruption, asset forfeiture, and money laundering. He represents clients in highly sensitive federal and state investigations conducted by the DOJ, SEC, CFTC, FTC, and New York Department of Financial Services. Pat also regularly counsels clients on best practices for corporate governance and ethics and compliance matters. Pat is the chair of the New York City Bar Association's Compliance Committee. Pat, we'll turn it over to you.
Thank you very much, Kristen. And first, I hope everybody is staying safe and healthy during these challenging times. And thank you all for spending a couple of minutes out of your late morning to join us on today's webcast. Today, we're going to discuss the risks that borrowers face under the CARES Act loan programs, with the focus on civil enforcement risks under the FCA, under FIRREA, and the steps borrowers and potential borrowers can take to mitigate those risks. But before we get into the substance of the program, I just want to spend a couple of minutes introducing the expert panel that we put together for you today. Bonnie Perlin is the Chief of Affirmative Civil Enforcement of the U.S. Attorney's Office for the Eastern District of New York. Bonnie has investigated, prosecuted, and supervised a wide variety of civil matters against both individuals and entities involving financial fraud, government contracting, government grant fraud, and consumer fraud and protection. Next slide, Kristen. Camille is a senior associate at BakerHostetler and part of the firm's bankruptcy and creditors' rights practice group. Camille concentrates her focus in the areas of corporate bankruptcy, financial restructuring, and commercial litigation. Camille represents debtors, creditors, trustees, and other interested parties across all industries. Camille also is a member of the New York City Bar Association's Bankruptcy and Restructuring Committee, where she serves as co-chair of the Voidable Transactions Subcommittee of that committee. She also serves as Director at Large for the International Women's Insolvency and Restructuring Confederation. Go to next. George is the managing partner of BakerHostetler's New York office and co-leader of the firm's Chambers USA ranked white collar group. George is a former Eastern District prosecutor, where he was, among other things, the deputy and acting chief for the office's organized crime section and chief of the office's Long Island division. George has tried dozens of complex federal jury trials as a prosecutor and as a defense attorney, and regularly counsels clients on FCPA issues and other criminal and civil white-collar matters. George has also been appointed as a federal monitor several times. Next. Peter is a director at Protiviti Forensics, a global risk and consulting firm. Peter provides consulting services to companies and individuals around the globe. He conducts white-collar investigations of financial crime, bribery, and misconduct. He also assists clients with FCPA program compliance, investigations, fraud risk assessments, background investigations, and other compliance items. Peter has extensive experience as an FBI special agent. He spent 24 years in that role, in charge of the FBI's New York white-collar branch, where, among other numerous investigations, he successfully managed the largest Ponzi scheme in history and the largest insider trading investigation in history. Kristen, if you go to next, there's me, and then we'll go to the next slide to start the program. So today we're going to be talking about the enforcement risk borrowers face under the CARES Act lending programs. We'll start off the presentation about talking about the past and the parallels between what we see now and what we saw after Hurricane Katrina and the 2008 financial crisis from a law enforcement perspective. As you all know, substantial funds were injected into the economy after those national crises. And when you look at the past, you see many of the things that happened then are happening today, and we expect to happen today. We will then discuss the key CARES Act lending programs with a focus on the Paycheck Protection Program and the Emergency Disaster Loan Program, which we'll call the EIDL. That program predates the CARES Act, but received additional funding under the CARES Act programs. We will then discuss the CARES Act oversight mechanisms with the focus on the Special Inspector General for Pandemic Recovery, which is one important parallel to what we saw after the 2008 financial crisis, when the Special Inspector General for the TARP program was established and appointed, and what we see today. We will then turn to really the crux of today's presentation, enforcement risks. Bonnie will give a general update on CARES Act fraud enforcement and the criminal actions, the several criminal actions that have already been brought so far, but she'll also discuss the potential civil liability under the False Claims Act, under the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIRREA, and some other statutes. While no actions for loan fraud have been brought under these civil enforcement statutes yet, Bonnie will discuss the outlook. We'll finish today's presentation with the risk mitigation steps that borrowers and potential borrowers can take now to mitigate these enforcement risks that we're going to talk about during today's presentation. You see on the slide a quote from the SIG-PR, Brian Miller. "We will hold accountable and bring to justice those who improperly take or use CARES Act money." There are several other quotes from law enforcement officials that are of this kind. And this really sets the theme, I think, for today's presentation. The criminal and civil enforcement risks are real. And involves federal prosecutors, inspectors generals from various agencies, the Small Business Administration, the IRS, and the Treasury, and several others. And eventually the SIG-PR. With Congress and the public continuously pushing for transparency and accountability. Notably, as we'll discuss later, the DOJ has already criminally charged at least 75 defendants with Paycheck Protection Program or EIDL loan fraud. This underscores the need, I think, to take the risk mitigation steps that we'll talk to you about later on during the program. Kristen, if you switch. So I'm going to turn it over to Camille to further set the stage and talk about some of the principles that may be underlying, the reasons why, so many criminal actions have been brought already.
Thank you, Pat. And hi, everyone. My name is Camille, and that's exactly right. We wanted to introduce this concept at the outset because it really provides a good framework for how we look at a lot of these issues. This diagram that you're looking at was developed by Donald Creasy. He's an expert who worked in the fields of criminology and white-collar crime. This fraud triangle has been developed over the course of many years since 1971, but it's broken down into three components. The first component is pressure. And with pressure, it can come from the economic environment or it can be more individualized. Pressure tends to increase in an economic downturn, and George is going to talk more about that in a moment. But it can also come in the form of pressure from analysts and investors that are looking to meet that are expecting the company to meet certain financial benchmarks or maintain financial results. Or it can come from pressure from meeting debt covenants or liquidity or financing requirements, things like that. The second component of this fraud triangle is opportunity, or really perceived opportunity. We're going to see a lot of this today as we walk through the materials, but look out for relaxed or deficient controls or a low perceived risk of getting caught. And third, rationalization. We're not going to spend too much time on this, but this component goes towards the fact that the vast majority of people that commit fraud, they're first-time offenders and they have no criminal history. And so they're looking for a way to rationalize their behavior. And some people may do this by stating that they're protecting the value of their company, or they're entitled to the money for some reason. But we're not going to get too far deep into that one, but just know for now that when you have these three components in high quantities, you have a high amount of pressure, you have a high amount of opportunity or perceived opportunity, and then you have the individuals rationalizing their behavior, the likelihood of fraud is far greater. Pat?
Thanks, Camille. And as Camille said, you'll see some of those components as we discuss further along in the program. The immense, economic pressures that are facing companies, and in the self-certifications that are part of the Paycheck Protection Program, and those items, and where we've seen individuals getting prosecuted so far, and how that relates to that. So if we go to the next slide, and George. So after Hurricane Katrina, what does the aftermath of the response to Hurricane Katrina and the 2008 financial crisis teach us about what to expect regarding CARES Act enforcement today?
Sure. Thanks, Pat. Thanks, Camille. And thank you, everyone, for joining us this morning. Well, as the slide indicates, history is something that can sometimes help us predict the future. And I think these are a couple of good examples. Would be in 2005, Hurricane Katrina, and then in 2008, the financial crisis. So we'll touch on those. As in those cases, and Hurricane Katrina, billions of dollars of federal funds flowed into the Gulf Coast region after the hurricane, and a task force was formed almost immediately after the hurricane in September of 2005. That task force included, as you would expect, federal, state, and local, FBI, DOJ criminal division, U.S. attorneys' offices in the region and around the country, DOJ civil division, IRS, postal, DHS, FTC, SEC, numerous IGs, inspector generals from the various departments, as well as I said earlier, federal, state and local, including enforcement, including the National Association of Attorneys Generals and the National Associations of Assistant District Attorneys and District Attorneys. The Katrina Fraud Task Force ultimately became part of the National Center for Disaster Fraud, NCDF, which was also established at the time of Hurricane Katrina. That Center for Disaster Fraud received complaints from both the general public and others, and it makes referrals out to the various prosecutors' offices and provides investigative support. Since its creation, the center received over 95,000 complaints related to alleged disaster fraud, but very interestingly, it has received already more than 76,000 COVID-related complaints. Looking, as what happened after all that money, billions flowed in Hurricane Katrina, is a great way to help you predict what might happen now that trillions have poured into to help the disaster. One of the another item relevant for today's discussion, DOJ brought civil FCA cases, False Claims Act cases, against companies and their owners for falsely holding themselves out as providing services they did not provide to obtain the federal contracts. You'll hear more about that in the present crisis and what some people have done. Turning to the second example from history that will help us predict the future here, 2008 financial crisis. Financial fraud task force was formed. It was established by President Obama in 2009 through an executive order to investigate and prosecute significant financial crimes and other violations relating to that crisis and the economic recovery efforts. It was led by DOJ, chaired by the Attorney General, consisted of senior officials from the various federal agencies. Then SIGTARP, the special IG for TARP funds and the TARP program. Well, that was established and the SIGTARP was selected and has authority to search, seize, and arrest and work with DOJ and other prosecutors to prosecute companies and individuals. Some various case examples, cases against banks for applying for TARP funds using false books and records, cases against companies who received TARP funds while engaging in criminal conduct. And the SIGTARP investigations have resulted in almost 389, I guess, defendants convicted, enforcement actions against 24 corporations, and the recovery of more than $11 billion, including recoveries of approximately $900 million in last year alone, 2019. So 11 years after the creation and the disaster, they're still bringing those kind of prosecutions and getting those kind of recoveries, civil and criminal. That tells me that 11 years from now, there'll still be prosecutions, investigations, and civil actions for the frauds that will be going on and have gone on already regarding the current pandemic and the financial aid that's been pumped into the community to assist it. Just last month on October 22nd, a man in Illinois was charged with making false claims to obtain federal mortgage assistance funds from TARP's Hardest Hit Fund. The indictment alleges the man took assistance but did not live in the home. So again, 11 years after its creation, there's still charges being brought. And so I think that's an important lesson from history there. I think we covered this.
Yep. And yeah, if you just back up again, Kristen. Thanks. Yeah. So George really took us through sort of the parallels that you see from that happened after those crises to now, the specific response and focus. I mean, tailored to sort of the even down to the region, the funds that were flowing and where the funds were flowing, the use of existing resources, the collaboration with state law enforcement, between state law enforcement, federal enforcement, special IGs, extensive investigations, and extensive criminal and civil investigations, enforcement, obtaining federal stimulus benefits on false pretenses. And, we saw a lot of false claims actions in Hurricane Katrina, 2008 financial crisis. This situation will be a little different, given the nature of how the funds are being distributed. In Katrina, we saw a lot of funds being distributed for reconstruction, things of that nature. But I think the themes are certainly parallel and important, and can be used to sort of give us a forecast of what's going to happen or what could happen. I failed to mention when we started that if you have any questions throughout the program, just put them in your Q&A box, and we'll reserve some time at the end to try to address the questions. And also some of the materials that we'll be discussing today as we go along, we'll send those to the participants after the program, along with a copy of the deck. But before we move on from this topic, Peter, I'd like to ask you, I mean, this isn't the first, time that folks are given presentations on risk management or, risk mitigation steps. I'm sure that the same was being discussed after Hurricane Katrina and after the 2008 financial crisis as to what companies should do after they, received funds from those stimulus packages. Any insights into what company, I know you're going to talk about this later in connection with this particular situation, but any insights into what companies and individuals are doing after receiving, stimulus funds during those crises from a risk mitigation standpoint?
Good morning, everybody. Yeah, so interesting. You know, as Camille mentioned, the fraud triangle comes to mind. Another thought comes to mind. You know, major disasters and fraud go hand in hand, and I've been living through this both in the government and private sector since 1987. So I've seen a whole litany of stimulus monies, disaster relief, so on and so forth, whether it's Katrina, the TARP, Hurricanes Andrew, Marilyn, 9/11, the 9/11 charities and the like that were established, FIRREA in the early 90s. You know, in addition to being the oldest person on the panel and having been living through this since 1987, you know, a lot of things do resonate. You know, the crimes become a little more sophisticated through the years, but it goes back to the fraud triangle that Camille certainly described earlier. You know, if you look at Hurricane Katrina, I think there's about $5.3 billion in aid that was granted. And depending upon what you read, but there's a GAO article based upon some GAO information, you know, anywhere from 600 million to 1.4 billion alone out of that 5.3 billion may have been lost to fraud. You know, the easy math that we use is expect, unfortunately, 10% of any monies that are distributed will be lost to fraud, waste, and abuse. You know, very, very unfortunate. When I look back at Hurricane Katrina, for example, you know, like with a lot of these stimulus package and disaster relief programs, you know, the goal, and rightfully so, is to get the money to those that need it very, very quickly. And we'll talk about the PPP later. You know, get it to people that need it right away. It's been a disaster. They need the funding. They need the relief. They need the help. But what happens a lot of time is the scrutiny and the like is not proficient or effective enough on the front end. And unfortunately, fraud does occur. In Katrina, you had prisoners in jails that were receiving aid. You had properties, people receiving monies for property damage for addresses that came back to cemeteries, for properties on the 12th floor of an office building, in a building that only had 3 floors. Members of the Red Cross, public officials were all involved in various kickback schemes, fraud-related events. You know, very, very unfortunate, but again, it's something that I've been able to witness from 1987 to the present. You know, certainly from a having investigated, having been part of investigations related to all the things I just mentioned, you know, one of the things that I've seen is people, again, in an attempt to receive monies, are not properly accounting for everything that they've requested, they've applied for, and importantly, the monies, the funds that they've received. You know, one of the things when we look at both from a government and a private sector standpoint, and we'll talk about enforcement actions and criminal statutes and everything as we go along. But number one, are any false statements used to receive these monies, false statements on loan applications? And were the monies used for its intended purpose? Okay, those are, in my mind, as an investigator working with prosecutors through the years, you know, those are the two parameters or the two barometers of you know, has a crime been committed? From a borrower standpoint, I can't overemphasize the need to document, account for everything from the application through the funding. And as George mentioned, you know, as part of the SIG-TARP task force in the 2008 financial crisis, you know, cases are still being brought. Whether it's a CARES Act, it'll be 10, 11, 12 years, and cases will still be brought. These aren't brought immediately. So from a borrower standpoint, you have to expect that there will be an audit at some point, and you need to put yourself in a defensible position that you can document, articulate all the areas that I've described.
Thanks, Peter. It's very, very helpful sort of insights, and we'll zero in on what Peter's talking about with respect to the specific components of the PPP, things like that. As we go along in the presentation. Kristen, if you would go to the next slide. Okay, so now we're going to talk about the CARES Act lending programs. You have a slide that shows you the overview. It was enacted in March 27, 2020. The largest relief package in history, just really dwarfs even the prior stimulus packages that we discussed. We're going to focus today on the Paycheck Protection Program and the Economic Injury Disaster Loan Program. Those are the programs that have seen the most activity thus far, both from borrowers' perspectives and taking money out, and also from a law enforcement perspective. You'll see that over $650 billion were allocated over time to the Paycheck Protection Program through the original act, and then through an amendment to the CARES Act. We'll touch upon the Main Street Lending Program, which also has a significant amount of funding that's been allocated to it. We won't spend so much time on it because that program hasn't been as heavily utilized as some would have expected. So, Kristen, if you go to the next slide. And now I'll turn it back to Camille to discuss the Paycheck Protection Program.
Okay, thank you, Pat. Of course, by now you've all heard of the Paycheck Protection Program, and a bit of context about how we got to where we are today. I don't have to remind you all, the first COVID case came about in New York on March 1st, and by March 7th, Governor Cuomo had enacted a state of emergency in New York, and things just escalated very quickly from there. You'll see on the slide that the CARES Act went straight to enactment by a few short weeks later, March 27th. Granted, this was on the radar before March 1st and March 7th, but it happened very quickly, and necessarily so. I mentioned this because it was a very fast process, and the loan application process also happened very quickly. On this slide, I have a few highlights of how the program works. Small businesses are eligible. You can either take out a loan or you can get it forgiven. If you end up taking out a loan, the payment terms are very favorable. You get 1% interest on the payments. And on the principal, you get a delayed start of payments. There are no prepayment penalties, and there are no collateral or personal guarantees required. I'm mentioning these because, think about this under the lens of the fraud triangle that I mentioned earlier. And you'll quickly realize there's a lot of room in the opportunity category here. No collateral, no personal guarantees. So maybe you can take out more than you need, right? Maybe that's what people are thinking about. It turns out a lot of people were thinking that way. And we'll get to this in a second, but, Peter, mentioned this as well, but the self-certification theme that is ongoing with these programs. All you have to do is verify that, you're eligible and that you qualify. And it's really the honor system, again, opportunity. So from there, at the top, we have the timeline of the different acts that followed the initial CARES Act. The PPPHCE Act, or the Paycheck Protection Program and Healthcare Enhancement Act, that was enacted 1 month later on April 24th. And that act increased the funding for the PPP from $349 billion to $659 billion because there was a huge demand for it, as we all know. And we'll talk about the EIDL program in a moment, but it increased the funding for that program as well by about $50 billion. From there, the PPP Flexibility Act was enacted on June 5th. And this act was very much needed. Because as I mentioned before, the CARES Act came out very quickly and there wasn't a lot of detail provided in terms of how the program would work. I actually worked with a nonprofit organization that was on a fiscal year that coincides with the school year. And they were looking at taking out PPP loan funding or receiving it. And before the Flexibility Act, it wouldn't have worked because they only got 8 weeks to spend the fund. One of the things that the Flexibility Act did was that it extended the time within which the companies or the borrowers can spend the funds. The key thing here with that Flexibility Act is that it was much needed. Borrowers now have more room to spend on the loan and apply for forgiveness. The last thing I'll mention on this slide is that the PPP program closed on August 8th. And so from there, now we're looking at loan forgiveness. That's been the shift with the coverage of this program, but we'll talk more about it later. I'll mention one more thing, that when it closed with 133 billion of the 59 billion still remaining. Those funds were unused. Next slide, please. So I won't spend too much time on this slide, but I wanted to include it to give you all a feel for the types of businesses that were actually eligible for the PPP loan on the left. And on the right, you have the actual borrowers by industry. And I organized it by the amount of loan dollars received from highest to lowest. So no surprise to anyone, healthcare, businesses within the healthcare industry got the most loan dollars by dollar amount. And then, a few of the other hard hit industries like construction, manufacturing, retail, like hospitality, accommodation, those industries also received a large chunk of the funds. Next slide, please. So this slide actually goes exactly to what Peter was talking about, right? Because there are two barometers that the officials are going to be looking at. They're going to be looking at the certifications, which we're going to talk about now, and they're also going to be looking at the use of the funds and if they were used for the purposes intended. So the key thing to note here is that the SBA, the CARES Act sent the money through to the SBA and the Department of Treasury, but they didn't really do a lot with the applications. That part of it is being handled by the lenders directly. So the lenders have been permitted to rely on certain borrower good faith certifications when they're approving the loans. And they did just that. They went by the word of the borrowers, again, the honor system. So to apply for a loan, the borrower has to verify a few things or certify a few things. Obviously, one, that it's eligible to participate in the PPP program, that they're providing an accurate calculation of their payroll costs, and that they're applying their affiliate rules properly. And think about the companies that have multiple affiliates. Are you, looking at those rules and making sure that everything's good to go? And then the next one, this one's pretty important. The borrower has to verify that, quote, current economic uncertainty makes the loan request necessary to support the ongoing operations of the applicant. And we've seen some companies get tripped up with this already, right? We've seen about 30 billion in funds very publicly returned to the program when people called them out or watchdogs called them out, like, do you really need this money? So keep that certification in mind. The funds have to be used to retain workers, maintain payroll, and importantly, if there's any confusion, borrowers up front on the application have to verify that they understand that knowingly making false statements is punishable by federal law. So I'll pause here to mention, as Pat said, that the loan application is available in the materials in case you want to take a look at that. And next slide.
Yeah, and just before we go to the next slide, Camille, just an observation and then the question to one of our panelists. You know, I think you'll mention later that the PPP is currently closed, but you know, there's been discussion, you know, in Congress and others about another stimulus plan, and you know, possibilities of this. You know, there are funds left in this program, and whether or not you know, this program might be you know, reinstituted or something, or maybe something similar. We don't know yet, but just keep that in mind that, you know, some of these items may very well, you know, be relevant again if another, you know, congressional act is taken and PPP is reopened. And I also just wanted to get Bonnie into the fold and just ask you, Bonnie, you know, when you see a program like this that, you know, that really relies on, you know, good faith certifications from borrowers, you know, how does that impact sort of the scrutiny that law enforcement may apply to this type of program?
So I think that, well, one, I just wanted to start by saying that the views that I present today are my own. They're not the views of the U.S. Attorney's Office or the Department of Justice. I do think that the self-certifications and the PPP program are going to be really important. I do think that although lenders are allowed to rely on the self-certifications, we also have to remember that, you know, some of these financial institutions may be getting applications from current customers where they already have information about those applicants. So they could, you know, they might not be okay just relying on self-certifications. But putting that aside, I think that, you know, these applications are very short, and the certifications for eligibility are, I think, going to be pretty easy for law enforcement and prosecutors to get behind in terms of just verifying whether or not they're actually true. So initial cases are going to come to the U.S. Attorney's offices in all different ways, through whistleblowers, perhaps, through agencies already investigating defendants for other things, and from the banks themselves through reports filed under the Bank Secrecy Act through FinCEN, which are then shared with law enforcement. And I think that, you know, once we see these referrals, they're really easy things that can be investigated. Like, for example, whether or not the borrower is in bankruptcy, has a criminal history, that's going to be checked, you know, right away. Whether or not they've been debarred, that's really important. And, you know, have it like any right to be participating in a government program to begin with. Whether or not they've already applied for PPP loans and received funds at another bank. Whether or not they are currently delinquent on other government loans is really important. Their certifications as to how they're going to use the funds. We've talked about, you know, whether or not they're eligible for the program to begin with, and then obviously we're all going to be focused on how the funds are used and whether they're used appropriately. And part of that is going to be looking at whether or not it's a legitimate business to begin with legitimate employees. And I think I know that we've already been seeing cases coming out of the department. I checked, we have a coronavirus response related DOJ website, which everyone can check at www.justice.gov/coronavirus. And there you can find recent press releases related to coronavirus fraud. There was a press release on October 29th coming out of the Central District of California, where the U.S. Attorney's Office filed a complaint charging an individual and his business partner for fraud relating to a PPP loan, for making false statements on the application, disaster loan fraud, wire fraud, bank fraud, conspiracy, and false statements made to the SBA. The defendants had applied for several PPP loans, I think totaling about $2 million. They used fake tax documents to substantiate reported employees that they didn't have. And some of the loans that were approved, two of the loans that were approved, the defendants had moved substantial funds from the business account where the funds were transferred to a personal account. And I expect to see that. I mean, that's just a very plain vanilla fraud. I think that we've seen throughout the history of government programs, that we're going to see more of that. But anyway, the certifications are going to be really important.
Mm-hmm.
Thanks, Bonnie, for those insights. Kristen, if you go to the next slide. These are just some of the use restrictions that Bonnie touched on about what the rules say on how the funds could be used. They become important, both for the application process, and as Camille will talk about in a second, from the loan forgiveness process, which is a big part that's on everybody's mind now with respect to the PPP. And importantly, at the bottom there, at least 60% of the loan proceeds must be used for payroll costs, which is one of the purposes of the act, is to keep individuals employed in these small businesses. Kristen, if you go to the next one. Here's a report. This will be in your materials, just sort of a statistics on the use of the PPP program, the extensive use. Interestingly, here also, there was a lot of public pressure for releasing the names of the companies who received loans. A lot of them were released. I think the ones above 150,000, there's been some more discussion about releasing names of the companies who received the loans of under 150,000. But again, here you see the statistics and the industries that received the majority of the funding, and Camille touched on that when she discussed the types of businesses that are eligible.
Sorry, Pat, really quickly, I just want to mention that's exactly right regarding the loans. A case just came out where some of the parties included Dow Jones and the Wall Street Journal and other news outlets. And the result was that the SBA now has until November 19th to release the names of the borrowers with loans that are over $150,000.
Thanks, Camille. So just to reinforce the notion of, with respect to this program in particular, borrowers just need to be careful
Right.
when they're filling out the loan applications. Again, that's done, but it could be, if Congress passes another act or institutes it, and as we get into loan forgiveness, which we'll talk about in a minute, which most companies haven't done yet. Kristen, if you go to the next one, and Camille, I'll turn this back over to you.
Sure. So we just wanted to show you a few of the recent developments that have gone on with the PPP. We've touched on a lot of them already. I won't repeat it. I'll just highlight though, for now that, on August 4th, 2020, the SBA released a ton of new FAQs, frequently asked questions on loan forgiveness. And then they opened the loan forgiveness portal 2 days later on August 10th. The fact that the FAQs are extensive, and the fact that they even updated them and released more guidance on October 13th, just about a month ago, tells us that this process of forgiveness is probably going to be much more rigorous than the initial loan application process. So keep that in mind. The other thing I wanted to highlight for you guys on this slide is that the September 2020 preliminary report that was released by the House Select Committee on the Coronavirus, that report is a little concerning. George is going to touch on it in a few minutes, but it caused Representative James Clyburn, and that's the chairman of the committee, to write a letter to the SBA and the Treasury Department's inspectors general, and request a review of the administration's management of PPP. And specifically in that letter, I think it's worthwhile to read it, but he said the subcommittee's analysis shows that PPP helped millions of small businesses and nonprofits stay afloat during the coronavirus crisis, but a lack of oversight and accountability from SBA and the Treasury may have led to billions of dollars being diverted to fraud, waste, and abuse, rather than to the small businesses that are truly in need. So keep that in mind. George is going to talk about that in a second in more detail. Next slide. Thank you. So loan forgiveness, right? Peter is going to go into much more detail about the considerations that borrowers should keep in mind as they go through this process. So I'm not going to fully take the wind out of his sails, but I will mention that you know, the key things to consider are up there on the slide. One recent thing that came out is that the loan, if the loan is over $2 million, the SBA has shown signs of its intention to supplement the existing loan forgiveness application with a new form. And that new form would assess the good faith certification that the loan was necessary. So I glanced really quickly in the questions that someone had a question about the timing of the certification of a loan, the good faith certification, and what date, you know, the officials will be looking at. They're going to be looking at it in the context of the loan forgiveness application. So keep that in mind. They'll also be looking at what you wrote on the original application. So if the information changed, there's a way to capture that on the loan forgiveness application. But just obviously be as forthcoming with the information as possible. The last thing I'll mention before I pause is that the forgiveness application is also available in the material, so take a look at that. So we're gonna pause to take care of housekeeping, I think, at this point. With the next slide, that's what you wanna write down if you want to get CLE credit, so write that down. The CARES Act 1 code.
Please record the code CARES Act 1 for the post-program evaluation. Please make sure to write down this code if you are requesting CLE credit, as you will be asked for it at the conclusion of this program. CARES Act number 1. I'll turn it back to you.
Thank you, Kristen. Okay, next slide, thank you. So that was the PPP program. The next slide that we're gonna discuss in a bit less detail is the Economic Injury Disaster Loan Program. And the key takeaways here are that this program predates the COVID-19 pandemic. And unlike the PPP loan program, this program is still accepting applications. There was a lot of demand for this loan program as well. It was originally available for up to $2 million in loan proceeds, and they had to subsequently reduce that amount significantly to accommodate for that increased demand. There's also a related program, the EIDL Advanced Program, and that program allows you to it provides literally $10,000 in funds while you're waiting for loan decisions. And the thing about this one is that you get to keep the money. If whether the loan is approved or not. So you apply for a PPP loan, and you need money to get you through till the loan is approved, and then so you'll get this $10,000 loan. If the loan is approved and it's a PPP loan, this $10,000 gets deducted from the amount that can be forgiven, but you don't have to give it back. This EIDL program ended on July 11th. And about 6 million small businesses received over 20 billion in advanced funds. Next slide, please. So really quickly, some key provisions about the EIDL program. You have to qualify for as a small business, obviously. And then again, I'm mentioning the fraud triangle because you start to notice the opportunity that comes up and the likelihood for fraud, but the applicant again here must certify that there's substantial economic injury. And what that means is that the business is unable to meet its obligations and pay its ordinary and necessary operating expenses. And then there are, other requirements. The funds can be used, can be used to cover a wider array of working capital expenses. But importantly, they cannot be used to refinance debt that's incurred prior to the pandemic. And last, probably obvious to most, EIDL funds and PPP funds cannot be used for the same purpose. So I know that the officials will be looking out for that. Pat?
Yep, thanks, Camille, for going over that. Kristen, if you go to the next slide. So there's the Main Street Lending Program. As I noted before, we're not going to spend a lot of time on it, but it's there for you to look at. And I think there's some materials on the Main Street Lending Program that will be included in your materials that we're going to send after. You see that 3.7 billion is given out, 400 loans. A lot of the public discussion about this program is why it hasn't been working in the way that it was envisioned to work. And just a couple of days ago, October 30th, the Federal Reserve again adjusted the terms of the program to try to bring more of the smaller businesses to be eligible. The key requirements on the right side, there's borrowers must commit to following compensation, stock repurchase, and capital distribution restrictions, make commercially reasonable efforts to maintain its payroll, retain employees. As Peter will talk about later on, when we get into the more concrete sort of risk mitigation steps, these are controls that companies, who have this, a loan from this program or loans from the PPP or EIDL, just need to focus on what are the requirements, then what are the controls that maybe you should consider putting in place to make sure that you're not running afoul of the requirements. And a key one here, is, maybe having to adjust certain, compensation policies or, capital distribution policies, and putting in the right controls to make sure that, the company doesn't run afoul of the criteria for this program and for the other programs. Kristen, if you go to the next slide. Okay, so now I want to turn it back to George to talk about some of the oversight mechanisms that were implemented as part of the CARES Act.
Sure, thanks, Pat. So the SIG-PR, the Special IG for Pandemic Recovery, has been compared to the SIG-TARP, which we talked about earlier, and that was active, and apparently still is, but was active and started back in 2008. As this slide notes, Brian Miller is the SIG-PR. He was confirmed by the Senate on June 2nd. His history suggests that there will be a lot of activity. He's a former federal prosecutor. He served as the IG of GSA, the General Services Administration, during the administrations of President Bush and President Obama from 2005 to 2014. Before that, he was advisor to U.S. Deputy Attorney General, an advisor to the U.S. Deputy Attorney General, and an assistant an AUSA in Eastern District of Virginia during the Bush administration. While he hasn't been noted in any publicly filed actions yet. He has been investigating, and he's made the arrangements in order to be able to access grand jury time in his old district. His initial focus has been on the Main Street lending program and the other exchange stabilization fund programs, including the CARES Act program that provide loans to airlines and related companies and businesses critical to maintaining national security. He, based on what he's indicated, in his reports and elsewhere, he believes these programs comprise part of his core jurisdiction. Now, one of his concerns has been companies taking loans from multiple CARES Act loan programs, multiple dippers, as they're so called. And while the CARES Act does allow borrowing from multiple programs in certain circumstances, he questioned whether multiple dippers could reasonably certify to an inability to secure credit elsewhere. As Camille referenced, in his first quarterly report to Congress, he made clear that his office is gearing up. He's entering into partnerships with several U.S. attorneys' offices to facilitate the legal process and case intake. These partnerships were intended to create streamlined and accelerated processes for his investigations and his coordination. As I mentioned earlier, including subpoenas and grand jury time and civil investigative demands. He's entered partnerships with other IGs, FinCEN, SEC, FINRA, and others, and he reported 21 preliminary investigations into allegations of improper activity, 7 of which have been referred to other IGs, and 1 of which is being worked in partnership with the U.S. Attorney's Office. Notably, however, he concluded that it remains unclear whether he has jurisdiction over the PPP and has invited Congress to clarify the lingering ambiguities that he sees. According to him, the PPP does not involve loans, loan guarantees, or other investments made by the Treasury Secretary, which is one limitation on his jurisdiction. To the contrary, as we know, the SBA guarantees the PPP loans, not the Treasury. However, it's an open question whether the Treasury Secretary manages the PPP. We've all seen Secretary Mnuchin talking about the PPP, and one would think, based on that he is looking to manage it, and if he is, then that would give Brian Miller jurisdiction. The SIG PR, Brian Miller, also notes that he received several letters from congressional members indicating that the CARES Act granted jurisdiction over PPP to his jurisdiction, to the SIG PR. He's indicated he'll make a definitive conclusion in his next report, but he invited Congress to amend the PPP to reflect whether his jurisdiction, whether he has jurisdiction over PPP or not. Given the relative inactivity of the Main Street lending program, which we'll touch upon later, this would be a big factor into how active Brian Miller and his team will be. We can go to our PRAC slide, the next slide, please. The PRAC, which is the Pandemic Recovery Accountability Committee, consists of the offices of 21 Inspector Generals, IGs, that oversee the agencies that receive the bulk of CARES Act funds and sits within the Council of Inspector Generals on Integrity and Efficiency, or SIGI as it's called. I'll note SIGI, the chair of SIGI is a former federal prosecutor out of New York, Michael Horowitz, who's had been the Inspector General of the Department of Justice since 2012, and also a former U.S. Sentencing Commission commissioner. Essentially, the PRAC coordinates and leads the efforts of SIGI and IGs to conduct oversight of the approximately $2.4 trillion in appropriated funds to address the pandemic, as well as the government's efforts in response to the coronavirus. Several of the criminal actions brought for alleged PPP or EIDL fraud have involved investigations by OIGs, to leading to indictments, complaints against 81 defendants, 69 arrests, and 5 convictions. The PRAC also made data public and issued several reports, including its June 17th report titled Top Challenges Facing Federal Agencies, C-19 Emergency Relief and Response Effort. The report is also, I believe, in your materials. The report makes clear that the PRAC and the OIGs are focused on fraud and cited several areas of concern by the OIGs who are overseeing the use of grant funds, obtaining timely and accurate financial performance information from grantees, and assessing performance to ensure that the grants achieved intended results. That report indicates that even more OIG audits and investigations are going to be coming down. Recently, the PRAC also issued its first semi-annual report to Congress, which provides a summary of what it does and what its accomplishments have been so far. That's also in your materials. Next slide, please. So other oversight bodies, the Congressional Oversight Commission, it's a bipartisan panel that reports to Congress every 30 days on how the Treasury and the Federal Reserve are managing CARES Act funds. Focused on Main Street Lending Program and other programs administered by Treasury and the Fed, including to airlines and related businesses and businesses deemed critical to national security. In its latest report, October 29th, the Commission reported on loan activity under these programs. Prior reports have questioned why Main Street Lending Program was not issuing the volume of loans it was expected to, and how the Treasury and Federal Reserve would ensure that recipients of the program are qualified, and how to use the MSLP funds and how they'll be monitored, the use of those funds. The CARES Act requires the GAO, the Government Accountability Office, to issue bi-monthly reports through the first of the year of the CARES Act. On June 25th, GAO issued its first report, finding, among other things, that agencies have made only limited progress so far in achieving transparency and accountability goals. The report took specific issue with the PPP and stated that, quote, the limited safeguards and lack of timely, complete guidance and oversight planning have increased the likelihood that borrowers may misuse or improperly receive such loan proceeds. One of the GAO's report's key recommendations was that the SBA administrator, quote, should develop and implement plans to identify and respond to risks in the PPP to ensure program integrity, achieve program effectiveness, and to address potential fraud, including in loans of $2 million or less. In its third report, issued on September 21st, the GAO noted, while the SBA has not finalized or implemented its audit plans, it informed the GAO that it will use data analytics to review PPP loans and will refer questionable loans to the SBA's OIG or the DOJ for further investigation. Speaker Pelosi compared the House Select Subcommittee on the Coronavirus Crisis to its mandate to the Truman Committee that was active during World War II, which investigated waste and fraud in defense spending. While the Truman Committee had an initial budget of only $15,000, the subcommittee's budget for 2020 is $2 million. It's chaired by, as Camille mentioned, Representative James Claiborne out of South Carolina, and it's been very active, that subcommittee, and especially critical of the PPP. Barely 2 weeks after its creation, the subcommittee sent and publicly released letters to 5 public companies demanding that they return their PPP loans and threatening investigations if they refuse. So we covered that. The information released by these demands made uncovered loans or revealed that there were information released about loans made to 4.9 million entities, and the SBA info on recipients of loans of less than 150,000. It limited that information to just names and addresses. But on October 30th, the committee, the House Select Subcommittee on the Coronavirus Crisis, released an interim staff report that made several findings, including that more than 22,500 loans worth $4 billion may have been subject to fraud, including loans that went to companies that received multiple loans, loans that went to companies that were excluded from doing business with the government or debarred and therefore prohibited from obtaining PPP loans, and loans that went to government contractors with significant performance and integrity issues. And then finally, loans that raise potential fraud concerns when compared against the federal government's system for award management database. On September 1st, Chairman Claiborne referred these potentially fraudulent loans to the Treasury and SBAIGs for examination. So those are just some of the other oversight bodies.
Thanks, George. And Chris, if you go to the next slide. So we've talked about the past. We've talked about the loan programs themselves. George just talked about the oversight mechanisms. Now turn it back to Bonnie to give the general enforcement update, and then just really to zero in on what we're here about today, which is the civil liability risk and the False Claims Act and FIRREA.
Thanks, Pat. So first I'm going to talk about how the SBA Office of Inspector General on October 28th issued a report on the EIDL program and their inspection of that program. As of July 31st, SBA OIG reported that SBA had received over 14 million EIDL applications and approved 3.2 million of them, totaling $169 billion. And I think Camille had mentioned that the most recent figure was about $190 billion for the program. And to put this in perspective, the SBA had only approved $11 billion in EIDLs in connection with Hurricane Katrina and $2.6 billion after Hurricane Sandy. Some of the additional findings that SBA OIG found were that SBA had approved $14.3 billion in EIDLs to accounts that differed from original bank accounts listed on applications, $62.7 billion in multiple EIDLs were approved to applicants with the same IP addresses, email addresses, bank accounts, or physical addresses, which clearly looks suspect. And 1.1, I think that's $1 billion in EIDLs and emergency advance grants were made to potentially ineligible businesses. SBA OIG noted there's strong indications of ongoing fraudulent activity. Law enforcement has already seized over $400 million from more than 15,000 fraudulent EIDLs. More than 5,000 EIDLs are under investigation, and additional investigations are ongoing. And it noted that the FTC, through its Consumer Sentinel database, had received 223,000 reports involving fraud, identity theft, and other complaints associated with the government's pandemic response as of October 14th. And how there's always a likelihood that if one loan is obtained, through fraud, through such as identity theft, that it's likely that those fraudsters obtained additional loans in the same way. Next slide, please. So this slide covers DOJ's most recent October 15th press release outlining the steps that the department has taken since March to combat COVID-19 related fraud. So this covers not only the loan fraud, but also like scams related to fake cures for COVID. And in this press release, the department warned the public about criminals that fabricate businesses and steal identities in order to defraud federal relief programs. Doug Rosen stated that a pandemic is a time when people should come together pursue the common good, but sadly that there are some who instead use it as an opportunity to deceive and thieve. Doug Rosen in March had directed the NCDF to take COVID-19 related complaints from the public and to facilitate sharing with law enforcement. If you go to that, the website that I had mentioned, the DOJ website for coronavirus fraud, there's a hotline number in case anybody wants it for the NCDF hotline is 866-720-5721. The department charged its first COVID-19 fraud case on March 25th and filed charges in an additional 33 criminal cases involving scam vaccines and treatments for coronavirus, or testing and price gouging. 11 civil enforcement actions have been filed under the fraud injunction statute, which we're going to talk about, but those have been focused on stopping consumer fraud, like such as, websites purportedly selling treatments to cure coronavirus, and not the loan programs yet. With respect to CARES Act related funding programs, the department has criminally charged 65 defendants in 50 cases related to the PPP and EIDL programs, involving intended losses of more than $227 million. Those cases have been, focused on particularly egregious conduct, like the case I had mentioned earlier, coming out of the Central District of California, or this example where defendants had fabricated businesses with names relating to Game of Thrones characters. You see defendants obtaining loans through these programs and spending them on lavish expenses like exotic cars, boats, and jewelry. And there have been alleged criminal rings that have engaged in organized activity to commit loan fraud under these programs, like by filing fake loan applications for others for kickbacks. And the department noted that we will aim to deter and prevent attempts by wrongdoers to prey on victims based on the potential enactment of new disaster relief bills. And I think there we're looking at, things like upfront fee scams. If you pay this upfront fee, we'll make sure that you're eligible to get a loan under this new program, and it's really a scam. Next slide. Pat, do you want me to continue?
Yeah, go ahead.
Okay. So now I'm going to go over the enforcement tools that we have on the civil side. Throughout the department and the U.S. Attorney's offices, we use both civil and criminal investigations, and it's not unusual for them to be done simultaneously through parallel proceedings. So one doesn't prevent the other. The civil statutes are generally much more generous than the criminal statutes in terms of the statute of limitations. So our statutes provide for up to 10 years from the time of the conduct to file suit. There are, on the criminal side of the house, instances where the statute of limitations is also 10 years if, like, for example, you have a mail or wire fraud case affecting a financial institution. They get that extension to 10 years as well. I'm going to talk about the False Claims Act and FIRREA. They both provide for investigative subpoenas to be issued by the U.S. Attorney. There's a large scope of remedies that we can seek under these statutes, ranging from damages to penalties to injunctions and other equitable relief. We have and we can file suits for claims under multiple statutes at the same time. So you could have a case, seeking damages under the False Claims Act, penalties under FIRREA, and an injunction. We have a lower standard of proof than criminal cases, a different scienter. We can look at reckless disregard or willful blindness. And we can go on to the next slide. I'm going to talk about the statutes. So the first one, which is the more common statute that we use at the U.S. Attorney's offices, is the False Claims Act. It establishes liability concerning false claims for payment from the United States. And the most commonly used provisions are if a defendant knowingly presents or causes to be presented a false or fraudulent claim for payment or approval, or knowingly makes, uses, or cause to be made or use a false record or statement material to a false claim or fraudulent claim. There's no proof of specific intent to defraud is required, and we only need to show under the statute, and I apologize if you hear a dog barking. His views are his own. We only need to show actual knowledge of the information or a defendant acted in deliberate ignorance of the truth or falsity of the information, or acted in reckless disregard. Next slide, please. And the False Claims Act provides that if a person violates the False Claims Act, they're liable not only for damages, which the statute provides for double damages. So like under the statute, if somebody fraudulently obtained, $100,000 through a loan program, we could, potentially collect $300,000 for that loan. And then on top of that, it provides for penalties ranging from $11,665 to $23,331. That amount keeps going up over the years, but for each false claim for payment. So, we I'm sure will be potentially using the False Claims Act to deter future fraudsters from trying to obtain funds under CARES Act programs if they see that people are potentially having to pay travel damages for defrauding the government. The False Claims Act, as well as FIRREA, provide for they have a whistleblower provision. So under the False Claims Act, the whistleblower is called a relator. They can file a QTAM action, which is basically for the person and on behalf of the United States government. And then the relator can seek a share of the government's recovery in that case, ranging from 15% to 30%. After a relator files a QTAM complaint, we investigate. We can use civil investigative demands during that time. The investigation and the case remain under seal. And we can issue civil investigative demands for documents, for testimony. We can interview witnesses, and for interrogatories, which is actually a unique thing under the False Claims Act. And the burden of proof is preponderance of the evidence. Next slide, please. And next, we're going to be talking about FIRREA, which the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, which you may have, if you're familiar with it, may also be familiar in the context of the government's litigation and investigations related to the residential mortgage-backed securities fraud. So FIRREA is it provides for civil action to recover basically very large penalties for violation of certain criminal predicate statutes, which include some of the predicates that may be more relevant for what we're talking about today are mail and wire fraud affecting a federal insured financial institution, bank fraud, false statements to influence a financial institution, false statements to influence SBA, like in relation to making an SBA loan under the PPP program. The maximum current penalty generally is $2.05 million per violation or $10.24 million for continuing violation. But the statute also provides that if there's a gain or loss involved in the violation, that the penalty can exceed those amounts up to the gain to any person derived from the violation or the loss suffered by a person other than the violator. I think there's a possibility that we could use this statute to obtain significant penalties, although the court has discretion as to the amount, but to try to obtain really significant penalties in smaller dollar cases where the False Claims Act, might not have as large of a deterrent effect. The burden of proof, just like False Claims Act, is preponderance of the evidence. We have, similar to the civil investigative demands that we can, our U.S. attorney can issue under the False Claims Act, there are FIRREA subpoenas, which the U.S. attorney can issue for documents and testimony. The unique aspect of FIRREA is that we are specifically authorized to use grand jury information, so that can be shared with the civil side of the house when conducting a FIRREA investigation. And the statute of limitations is 10 years from the conduct at issue. Next slide. FIRREA has its own whistleblower provision under FIRREA, the Financial Institutions Anti-Fraud Enforcement Act of 1990. Whistleblowers can file, basically, instead of a complaint, they file a declaration of a violation giving rise to prospective government claims under FIRREA. The whistleblowers under FIRREA are entitled to a more limited share, so they can potentially get a share of the government's recovery up to $1.6 million. Again, the whistleblower does not file a complaint. Basically, under the statute, the government will investigate the allegations set forth in the declaration and then notify the whistleblower if we're going to file a complaint or if we decline. Next slide. And another tool that we have is the fraud injunction statute, which is section 1345 of Title 18. We most recently used this to enjoin certain VoIP phone carriers who were carrying government imposter robocalls into the country from India and other places. So it's a pretty powerful statute, which we can use to preliminarily and permanently enjoin certain ongoing criminal acts, including mail and wire fraud, mail or wire fraud conspiracy, false statements to the United States, false claims to the United States. The burden of proof is probable cause, at least at the TRO and PI stages. And we may possibly use the section 1345 to seek to enjoin fraudulent conduct, use of fraudulently acquired funds through the PPP and other CARES Act programs, possibly to enjoin defendants from participating in any government program. And we can also potentially seek restitution, which is like similar to what the government can get in a criminal case on behalf of victims. This statute could also potentially be used to enjoin future upfront fee scams relating to these programs. Next slide. So this slide basically summarizes like my thoughts and where I think we may be seeing future cases under the False Claims Act, FIRREA, or a Section 1345. So we may be seeing future cases filed based on false claims for CARES Act funds, for fictional businesses that are not functioning, or applications made based on stolen identities. Some of those like very easy certifications to disprove. We may be bringing cases based on false statements made, about whether or not an applicant was in bankruptcy, is a convicted felon, has previously been debarred, has prior delinquent federal loans, or other disqualifying information. We could potentially bring cases based on defendants trying to get around the requirements of, that you can only apply for one loan under a program, or the maximum amount allowed under a program, where defendants are just applying to multiple banks, or under different, newly formed entity names. We may see, and I think the PR had mentioned this in his report in part, the false statements concerning the ability to secure credit somewhere else and the need to actually get funds from a specific program. We may see false certifications that the United States is the primary residence of the employees of a business applying for a program. We're definitely going to see and have already seen applicants using funds to pay for lavish personal expenses. And again, we may be seeing cases based on advanced fee schemes.
Yep, thanks, Bonnie, for those interesting perspectives on, again, what may be coming down the road in terms of potential civil liability, but all the action now in the PPP world and the EIDL world being focused on the criminal side. That's a very interesting perspective on the civil liability tools in DOJ's arsenal and how they may apply. We have a few minutes left, but Peter, if you just bring us home with some comments on risk mitigation.
Certainly. So in the last 87 minutes, hopefully we provided information on the different programs that are eligible for borrowers. Probably spent a good chunk of that scaring the heck out of you. We're talking about fines, penalties, punishments, and the like. So wanted to spend a few minutes. We've got about 83 minutes left or so. I don't have a problem being a fast-talking New Yorker. So just quickly, back in the day when I worked with prosecutors like George and Bonnie, and what we were told kind of from day one in the FBI was, day one of any work that you do, any investigation you do, you prepare for a trial. Okay, you prepare for a trial that may happen 2, 3, 4, 5 years down the road. Similarly, with the stimulus monies and related to the CARES Act, on day one, prepare for an audit. Okay, think about what you will need for an audit 4, 5, 6, 7, even longer down the road. You want to be able to document everything, whether it's electronic, whether it's in banker's boxes, whatever it is. Think about what you may need if somebody comes knocking at your door, or you get that ominous email, asking for you to produce documents to support your application and the funds that you received. Each of the different programs has its own little nuances. Interestingly enough, the Main Street Lending Program really hasn't been as successful as everybody thought. And that's because it's based on cash flow projections and calculations and the like. The others are more based on assets, number of employees. I think in the Main Street Lending Program, there was about over $500 billion allocated. At the end of October, I think it was less than $4 billion had actually been funded. And they're trying to remedy that and see what they can do. But most importantly for those borrowers, again, prepare for an audit on day one. Make sure that you have the controls in place to be able to articulate why decisions were made, what approval authorities, what segregation of duties are in place. Very, very important. And, for those, small to medium businesses that may not have a robust finance team or accounting team and the like, I would encourage, you solicit assistance from an attorney, from an accountant. Do not take this lightly, okay? You will be asked to produce and be able to document everything you've requested and everything you've received.
Okay, thanks, Peter. Kristen, you go to the next slide. There's our takeaways. I mean, we've talked about them all. Just stay informed. These rules changing, more guidance still coming out. Carefully complete your applications. And as Peter said, maintain your documentation, maintain your records, maintain controls, expect to be audited, not tomorrow, but even 5-7 years from now. Kristen, if you want to go to the CLE code. So
All right, this is code number 2 of 2. Please record the code CARES Act 2 for the post-program evaluation. Please make sure to write this code down if you're requesting CLE credit, as you'll be asked for it in just a moment. CARES Act, the number 2.
Thank you. Yeah, we didn't have I think we're out of time. There were a couple questions. Sorry, we couldn't get to all of them. I know there was one about the statute of limitations when we talked about the SIGTARP action. I would just say for that one, the hardest hit fund is still open, which is also another indication of how long these stimulus programs work. But also there were certain statute of limitations that could go to 10 years when you're talking about mail fraud and wire fraud affecting financial institutions and other statutes that have 10-year limitations. There was another question about I believe it was about how does a borrower approve financial need for a PPP loan. I would just refer you to the SBA frequently asked questions. When you'll receive our materials, there's some guidance in that document about financial need and access to liquidity and all that stuff. So you could take a look there. So, all right, well, thank you all. Thank you, panelists. Great and interesting discussion. Thank you for everybody who spent your early morning, late morning, it's early afternoon with us. And I hope everybody has a great day.
Thanks, Pat. Take care, everyone.
Thank you, Pat.
Thank you.